Disclaimer.
Most people think the financial system is a game of supply and demand. They're wrong. It's a game of plumbing. And at 9:30 a.m. today, the pipes officially ran dry. The Fed's last line of defense, the $2 trillion reverse repo facility, just hit zero. And while you were sleeping, a 2:47 a.m. post didn't just anger politicians. It triggered a Six Sigma collapse in the global insurance market. Lloyds of London just froze $4.2 trillion in sovereign debt protection. This isn't a dip. It's a structural divorce from the paper reality we've lived in for 40 years. The data I'm about to show you confirms that China is no longer just selling our debt. They are liquidating the very ghost inventory of silver that keeps your bank solvent. They are trading paper promises for Tier 1 physical collateral at a rate of $50 billion a month. And they're doing it through secret proxies in Belgium to hide the blast radius. The math says we have until February 27th before the COMEX is forced into a delivery default that will make the 1980 Hunt Brothers squeeze look like a rounding error. If you are holding paper silver, you aren't an investor. You are exit liquidity. Today, we do the autopsy on the dollar and reveal the specific price targets for the greatest wealth transfer in history. Let's get to the truth. Here's what that 2:47 a.m. message actually did. According to confidential sources within the Bank for International Settlements, it contained specific language that invalidated the legal framework for cross-border collateral verification. Think of it like this. Imagine you're buying a house, and right before closing, someone proves that the title company can't actually verify who owns the property. The entire transaction freezes. Now multiply that scenario by every international trade deal, every sovereign bond, every currency swap that relies on verified collateral. 12 nations lost their insurance backing overnight. And those 12 nations represent the collateral backbone for everything from oil shipments to pharmaceutical imports. Where does that tsunami of unwanted dollars flow when there's no RRP buffer to absorb it? Straight into commodity markets. Specifically, the one commodity that China has been systematically accumulating while our institutions have been systematically shorting it. Silver. According to the London Bullion Market Association, global silver inventories in London. Good delivery vaults have dropped by 30% in the last 90 days. 30% of the world's verified silver reserves have vanished from the legitimate market in under 3 months. Those same Belgian custodians processing the Treasury liquidation are simultaneously draining physical silver bars. Real, tangible, 1,000-ounce bars stamped with London Good Delivery certification. Here's what Wall Street doesn't want you to understand. The entire modern banking system treats silver as Tier 1 collateral. That means banks can count silver holdings on their balance sheets as if it were cash. But there's a critical requirement for that designation. The silver must be verifiable and deliverable. When Lloyds froze sovereign debt insurance, they didn't just affect government bonds. They triggered what risk managers are quietly calling a collateral blackout. Banks can no longer verify the value or even the existence of the paper silver claims they are using to maintain their capital requirements. Let me put this in perspective for you. Right now, the COMEX has 356 paper claims for every single physical ounce in their vaults. That's not a healthy market. That's a Ponzi scheme waiting for someone to ask for actual delivery. Physical delivery demands are already running 400% above the 10-year average, and that was before the insurance freeze made verification impossible. Think about what that means for your portfolio. If you own silver ETFs, those convenient exchange-traded funds that let you invest in silver without touching the physical metal, you are holding a claim on silver that might not actually exist. The prospectus for the largest silver ETF, buried in the fine print on page 73, contains a clause that allows them to settle in cash rather than metal during extraordinary market circumstances. Want to guess what qualifies as extraordinary? A collateral blackout where they can't verify their own inventory. Let me give you a real-world scenario. You bought shares in a silver ETF 2 years ago when spot price was $19 per ounce. Today, spot price shows $29. You think you've made a 50% return. But when you try to redeem those shares for physical metal, because maybe you've been reading stories about banking instability and you want something tangible, you discover several problems. First, your ETF doesn't actually allow individual investors to redeem for physical metal. Only authorized participants, usually large banks, can do that. Second, even if you could redeem, the ETF would settle in cash at spot price, not at the actual physical premium dealers are charging. Third, and most concerning, if the ETF faces mass redemption requests, that cash settlement clause gets triggered and you receive dollars that are rapidly losing purchasing power instead of metal that's gaining it. This isn't theoretical. During the banking crisis of March 2023, when Silicon Valley Bank collapsed, several precious metals ETFs briefly suspended creations and redemptions. The spreads between paper price and physical premiums widened to historic levels. Dealers were charging $15 over spot for Silver Eagles. Some products had 6 to 8 week delivery delays. The market was screaming that paper and physical were diverging, but the official spot price barely moved because the COMEX paper market continued functioning normally. Now imagine that same scenario, but instead of one regional bank failing, you have the entire sovereign debt insurance market frozen and the 5 largest banks in the country facing insolvency. How wide do you think those spreads become? How long do you think delivery delays stretch? But here's where the story gets truly disturbing. The Federal Deposit Insurance Corporation, in their quarterly banking profile released last month, confirmed that U.S. banks are currently sitting on $720 billion in unrealized losses. Those are losses that exist on paper, but haven't been officially recognized yet, mostly from long-term bonds that are now worth less because interest rates have risen. The banks are technically insolvent, but as long as they don't have to mark those bonds to market value, they can keep operating. This is where the Lloyds insurance freeze becomes catastrophic rather than merely concerning. When sovereign debt insurance disappears, bond yields spike because investors demand higher returns for uninsured risk. Every 1% increase in the 10-year Treasury yield creates approximately $70 billion in additional unrealized losses for our banking system. We're not talking about small regional banks here. According to Office of the Comptroller of the Currency reports, the top 5 banks in our country hold 93% of all derivatives exposure in the U.S. banking system. Now here's the connection most analysts are missing. Those same 5 institutions, JP Morgan, Bank of America, Citigroup, Goldman Sachs, and Morgan Stanley, collectively hold massive short positions in silver futures. These aren't speculative bets. These are hedges against the Tier 1 silver reserves they claim on their balance sheets. If yields hit 6%, which multiple bond market analysts are now predicting as the floor rather than the ceiling, you're looking at mathematical insolvency for the very banks that would need to deliver physical metal they don't actually have. Think about the timing here. If even 20% of February silver contracts demand physical delivery, these banks face a choice between admitting they're short the metal or admitting they're insolvent from bond losses. Either admission triggers a cascade, the first domino tips, and suddenly every bank with similar exposure faces a silent run as sophisticated investors quietly withdraw before the panic becomes public. You're probably wondering why you haven't heard about this from your financial advisor or on mainstream financial news. The entire narrative structure of modern finance depends on you believing that paper claims are just as good as physical assets. The moment enough people understand that distinction and start demanding actual delivery instead of accepting cash settlements, the entire system of fractional reserve metal banking collapses overnight. That moment is closer than you think. While you've been focused on stock market rallies and cryptocurrency drama, a systematic dismantling of the Western financial architecture has been underway. That 2:47 a.m. message wasn't the beginning. It was the signal that the endgame has officially started. Here's what you need to understand right now. The gap between the COMEX spot price for silver and the actual cost of obtaining physical metal is widening by the day. Dealers are charging premiums of $8 to $12 per ounce above spot price, and delivery times have stretched from 2 weeks to 6 weeks for standard orders. That spread is telling you something critical. The decoupling has already begun. You just haven't been told yet. Now, let me show you the forensic evidence that confirms this is not speculation. It's a calculated liquidation that has been running in plain sight for over a year. You want proof? Let's start with Treasury International Capital data, the official reporting system that tracks foreign holdings of U.S. securities. According to the most recent TIC reports, China, as official Treasury holdings have declined from $1.07 trillion in early 2023 to just $780 billion today. That's a $290 billion reduction in the official numbers. But here's what should make your blood run cold. When you dig into the custodial data, the records that show which banks are holding these treasuries on behalf of foreign governments, you find something extraordinary. Belgium's custodial treasury holdings have fluctuated by over $100 billion in the past 18 months. Belgium, a country with a GDP of $600 billion, is somehow moving amounts equivalent to 15% of its entire economy through its custodial accounts. Luxembourg shows similar patterns, with custodial holdings swinging by $70 billion quarter to quarter. These aren't normal trading patterns. These are shell game mechanics, designed to obscure the true origin and destination of capital flows. When China wants to liquidate treasuries without triggering market panic or political backlash, they route the transactions through these European custodians. The bonds get sold, the dollars get converted, and the trail gets intentionally muddied. But the World Gold Council and the London Bullion Market Association track something China can't hide quite as easily: physical metal movements. According to LBMA vault data, cross-referenced with export statistics from the UK's HM Revenue and Customs, over 900 metric tons of silver bars have been withdrawn from London good delivery vaults in the past 90 days. That's 30 million ounces. At current prices, that represents roughly $870 million in physical metal. But here's the critical detail. Those withdrawals weren't evenly distributed. They spiked dramatically in periods immediately following large Belgian custodial treasury movements. The correlation isn't circumstantial. It's forensic. Let me walk you through one specific example. In October, Belgian custodial accounts showed a $42 billion decrease in treasury holdings according to TIC data released in December. That same month, London Silver Vault holdings dropped by 320 metric tons, the largest single-month decline on record. The timing isn't coincidental. Someone is systematically converting our depreciating sovereign debt into physical silver at a ratio that suggests they understand exactly what's coming. They're not diversifying, they're escaping. Now you might be thinking, why silver? Why not gold, which has traditionally been the safe haven asset? Here's where the strategy becomes brilliant in its ruthlessness. Gold markets, while manipulated, have enough physical delivery infrastructure and enough sovereign buying to make cornering difficult. The gold-to-paper ratio in futures markets runs about 20-1. That's still fractional, but it's manageable. Silver, on the other hand, has been systematically drained from above-ground inventories for decades, while paper claims have exploded to 356-1. The silver market is smaller, less liquid, and exponentially more vulnerable to a physical squeeze. China isn't just buying silver. They're buying the leverage point that can collapse Western banking's Tier 1 capital structure. Every ounce they pull from London vaults is an ounce that can't be used to settle the futures contracts our banks have written. Every bar they lock in Shanghai vaults is a bar that makes the fractional reserve scheme more unstable. They're not making a bet. They're springing a trap that took decades to set. But the liquidation strategy goes deeper than just converting treasuries to metal. According to sources familiar with international clearing operations, there's been a systematic withdrawal from Western financial infrastructure itself. The legal architecture that allowed U.S. authorities to track and potentially freeze foreign assets is being dismantled through what lawyers are calling conditional legal clauses. The Netherlands and France have both inserted language into recent bilateral agreements that essentially says, if the security alliance dissolves, so does our obligation to honor your subpoenas. Think about what that means. For the past 40 years, the Department of Justice and the Treasury Department have maintained financial oversight over global markets through a web of information-sharing agreements and mutual legal assistance treaties. When our authorities wanted to investigate manipulation in silver markets, and they have, repeatedly, they could compel European banks and clearinghouses to turn over transaction records, client identities, and trading data. Those investigations consistently found irregularities, but rarely resulted in meaningful prosecution because the manipulation was too systemic and the players too important to the broader financial system. But now, European allies are quietly inserting language into agreements that creates legal escape hatches. If NATO fractures, if security guarantees get questioned, suddenly those information-sharing obligations become conditional rather than guaranteed. The DOJ's ability to track the ghost custodians evaporates. Our regulatory oversight over the very banks that have been shorting silver for decades becomes toothless. This isn't accidental. This is strategic preparation for a post-American financial order. Let me show you how this plays out in practice. In 2015, Deutsche Bank settled with U.S. authorities for manipulating precious metals markets. The settlement required them to turn over evidence and cooperate with ongoing investigations. That cooperation was predicated on the bank's desire to maintain access to U.S. dollar clearing systems and to avoid more severe penalties that could have threatened their ability to operate in our markets. The threat of being cut off from dollar infrastructure was the leverage that forced compliance. Fast forward to today. European banks are watching the insurance freeze, seeing the RRP hit zero, observing the systematic liquidation of treasuries, and they're making a calculation. What if dollar clearing access becomes less valuable than the alternatives? What if the Chinese yuan trade settlement system, the Russian SPFS network, and the European instant payment infrastructure collectively create a viable alternative to SWIFT? Suddenly, the leverage our authorities have been using to enforce financial compliance disappears. This is why the timing of the 2:47 a.m. post matters so much. It wasn't random diplomatic theater. It was a signal to financial institutions across Europe. The security umbrella you've operated under for 70 years is conditional, not permanent. Start preparing for a world where American financial hegemony is optional rather than mandatory. And those institutions are responding exactly as you'd expect, by creating legal structures that give them plausible deniability and regulatory escape routes. The FDIC data confirms what the TIC flows and the legal preparations are telling us. Our banking system is sitting on $720 billion in unrealized losses, but that number only tells part of the story. Those losses exist at current interest rates. The insurance freeze is pushing yields higher by the day. The 10-year Treasury touched 4.7% yesterday. Bond traders are whispering about 5% by March. If yields hit 6%, which the forward curves are now pricing as increasingly likely, we're not talking about unrealized losses anymore. We're talking about actual insolvency for institutions holding long-duration bonds. Here's the mechanism most people don't understand. When banks buy long-term treasuries, they're essentially making a bet that interest rates will stay low. If rates rise, those bonds lose value. Banks can pretend those losses don't exist by claiming they'll hold the bonds to maturity. But if the insurance market collapse forces them to mark those bonds to current market value, which happens if they need to post them as collateral or if regulators demand it, the losses become real. Capital ratios fall below regulatory minimums. The bank becomes technically insolvent. Now add the silver short positions to this equation. JP Morgan alone has been estimated by industry analysts to hold short positions in silver futures, equivalent to roughly 200 million ounces. At $29 per ounce, that's a $5.8 billion position. If silver runs to $50, which is still below the inflation-adjusted highs from 1980, that position loses $6 billion. For a bank that's already facing hundreds of billions in bond losses, a $6 billion commodities loss becomes the difference between surviving the crisis and requiring a government rescue. Bank of America's exposure is even more concerning. According to OCC derivatives reports, they hold concentrated positions in precious metals, derivatives that dwarf their market-making obligations. These aren't hedges for customer activity. These are proprietary bets that silver will stay suppressed. When physical delivery demands exceed available inventory, these banks face a choice. Buy physical silver at any price to settle contracts, or declare force majeure and settle in cash at a price that is completely disconnected from the physical market reality. Either choice destroys confidence. If they buy at premiums $30 or $40 above COMEX spot to secure physical delivery, they're admitting the paper price is fiction. If they invoke force majeure and settle in cash, they're admitting they never had the metal to back the contracts in the first place. Both admissions trigger the same result: a rush for physical metal, the collapse of paper pricing mechanisms, and the revelation that silver's true value is multiples higher than the suppressed spot price we've accepted as legitimate. This is what February 27th represents. It's not just another contract expiration. It's the convergence point where all these pressures, the Treasury liquidation, the insurance freeze, the legal framework dissolution, the banking insolvency, and the silver shortage, collide simultaneously. The system either delivers metal it doesn't have or admits that modern banking is built on fractional reserve fraud that finally got called. China knows this. Russia knows this. The Europeans are positioning for it. The only people who don't seem to know are the retail investors still believing that paper silver in their brokerage accounts represents actual metal they can access when needed. You are being systematically positioned as the exit liquidity. Your paper claims will be settled in dollars that buy less every day, while physical metal becomes unavailable at any price. Let's talk about February 27th. In futures markets, this date is called First Notice Day, the first day when holders of expiring contracts can demand physical delivery instead of rolling their positions forward or settling in cash. Normally, this is a routine administrative event. 98% of futures contracts get rolled or cash settled. Only a small fraction ever demand actual metal. The system is designed around that assumption. But February 27th, 2026 is different. According to COMEX clearing data, open interest in February silver contracts currently represents approximately 178 million ounces of potential delivery demands. The COMEX registered vaults, the metal actually available for delivery, currently hold 50 million ounces. That's a 3.5 to 1 ratio. Under normal circumstances, when only 2 to 3% demand delivery, the math works. 50 million ounces can satisfy 5 million ounces in delivery requests with room to spare. Here's your problem. These aren't normal circumstances. With the insurance freeze making sovereign debt verification impossible, with the RRP at zero leaving no buffer for Treasury liquidations, with European legal frameworks crumbling, sophisticated traders are making a different calculation. They're looking at the same data you're seeing now and they are asking themselves, what's more valuable? Paper claims settled in depreciating dollars or physical metal I can hold outside the banking system? When delivery demands hit even 15% of open interest, the math breaks. 15% of 178 million ounces equals 26.7 million ounces. The COMEX vaults hold 50 million ounces total, but remember, not all of that is registered for delivery. Some is allocated to specific owners. Some is held as eligible inventory that could be registered but currently isn't. The actual deliverable silver, according to the most recent warehouse stocks report, is closer to 38 million ounces. Now add one more variable. China's Belgian custodians are draining London vaults at a rate of 300 metric tons per month. That's 9.6 million ounces monthly. That's leaving the Western banking system entirely. Between now and February 27th, that's another 29 million ounces that won't be available to backstop COMEX deliveries. The global pool of deliverable silver is shrinking while delivery demands are accelerating. This is a mathematical countdown to default, not a market prediction. But it gets worse. The banks that are short these contracts can't simply go to the spot market and buy physical silver to cover their obligations. There isn't enough physical silver available at current prices. When dealers are already charging $8 to $12 premiums over spot for retail products and delivery delays have stretched to 6 weeks, what happens when JP Morgan tries to buy 50 million ounces in the open market? They drive the price into territory that makes their entire derivatives book insolvent. This is what traders call a squeeze. The short positions are so large relative to available supply that any attempt to cover those positions by buying physical metal causes prices to spike, which creates margin calls on other short positions, which forces more covering, which drives prices higher in a self-reinforcing loop. The Hunt brothers triggered a version of this in 1980 when they tried to corner the silver market. Prices went from $6 per ounce to $50 in less than a year. But the Hunt brothers were using borrowed money and got wiped out when the rules changed and margin requirements increased overnight. This time is different. China isn't borrowing. They're converting depreciating treasuries into physical metal using their own capital. They can't get margin called. They can't be forced to liquidate. They're playing the long game with a sovereign balance sheet that doesn't have quarterly earnings calls or investor redemptions. They can wait. The banks shorting silver can't. So what's silver actually worth when you remove the paper manipulation? Let's run the numbers using historical monetary metrics. In 1980, when silver hit its inflation-adjusted peak of $150 per ounce, in today's dollars, the M2 money supply stood at approximately $1.6 trillion. Today, M2 is at $21 trillion. That's a 13-fold increase in the money supply. If we apply that same ratio to silver's role as monetary metal, the equivalent price today would be approximately $214 per ounce. That's not speculation. That's just maintaining silver's purchasing power relative to the expansion of the dollar supply. We're currently trading at $29. The gap between current price and fair value based on monetary fundamentals is $185 per ounce. That gap exists because the paper market has suppressed price discovery for decades. But the $214 figure assumes normal market conditions, an orderly price discovery. What happens during a squeeze when covering short positions becomes an existential crisis for major banks. Historical volatility analysis of commodity squeezes suggests price overshoots of 50 to 100% above fair value during peak panic. That puts the moonshot target somewhere between $310 and $428 per ounce. Now, I'm not telling you silver will definitely hit those prices. I'm showing you what the math says becomes possible when fractional reserve schemes collapse and paper claims get exposed as fraud. The February 27th timeline gives this scenario a specific catalyst and a deadline. Either the COMEX finds a way to satisfy delivery demands with metal they don't have, or they invoke force majeure and admit the paper market is fiction. Force majeure is a legal term meaning superior force, an unforeseeable circumstance that prevents someone from fulfilling a contract. In futures markets, it's the escape hatch that allows exchanges to settle contracts in cash when physical delivery becomes impossible. The COMEX has invoked force majeure before, most notably in palladium markets. When it happens, the cash settlement price gets set by the exchange, not by the market. And here's the critical detail. That settlement price is almost always disconnected from the actual physical market price. Think about what that means for you. If you're holding paper silver contracts or ETF shares expecting to profit from the squeeze, and the COMEX declares force majeure, you get paid in cash at whatever price they decide is fair. Meanwhile, physical silver is trading at premiums $30 or $40 above that settlement price. You just got arbitraged out of the real gains by the very institutions that created the shortage in the first place. This is why the distinction between paper and physical isn't academic. It's the difference between participating in the greatest wealth transfer in modern financial history and being the exit liquidity that funds it. Every day you hold paper claims instead of physical metal is another day you're trusting the same institutions that are mathematically short by 356 to 1 to honor their obligations when the squeeze happens. But there's a final layer to this that most analysts aren't discussing yet. What comes after the COMEX default? How do governments and central banks respond when it becomes obvious that the entire fractional reserve commodity system is built on fraud? According to monetary policy, white papers from the Bank for International Settlements, the answer is already being prepared. Central bank digital currencies with embedded security layers. These aren't conspiracy theories. The Federal Reserve has been openly testing a digital dollar platform. The European Central Bank is piloting the digital euro. China's digital yuan is already operational. These systems have a feature that physical cash and current bank accounts don't: programmable restrictions. and what assets you can convert your currency into. They call it security. What it really means is control. Here's the scenario that keeps me up at night. The COMEX defaults. Silver prices moonshot. Banks face insolvency. The government steps in with emergency measures to stabilize the financial system. Part of those measures includes rolling out CBDC infrastructure to protect depositors and prevent money laundering. Suddenly, your ability to buy physical silver gets restricted to prevent hoarding or ensure equitable distribution. Your digital dollars are programmed to only purchase approved assets. Physical precious metals aren't on that list. This is the liquidity trap the title warned you about. We're in the final window where you can still convert fiat currency into physical sovereignty. Every day that window gets smaller. Every ounce that gets drained from Western vaults is an ounce you can't access later. Every paper claim you trust is a claim that will get settled in currency that's losing purchasing power by the hour. The math is undeniable. The RRP at 0 means no buffer. The insurance freeze means rising yields and banking insolvency. The Belgian custodial flows mean systematic liquidation of Western debt into Eastern metal. The COMEX leverage at 356 to 1 means delivery default is mathematical certainty, not market risk. February 27th is the catalyst that forces this underwater pressure to the surface. Your move now determines which side of the wealth transfer you end up on. You can keep trusting paper claims issued by institutions that are provably short by ratios that make Lehman Brothers look conservative. Or you can recognize that we're watching the controlled demolition of the dollar-based financial system and position yourself in the physical assets that will retain value when the architecture collapses. This isn't fear-mongering. This is forensic analysis of publicly available data that points to a singular conclusion. The system that has suppressed silver prices for decades is mathematically terminal. The timeline is visible. The price targets are calculable. The only question is whether you'll recognize the pattern before the exit closes. The 2:47 a.m. post didn't start this. It announced that the endgame has begun. Everything from here forward is just watching the inevitable math play out. The $4.2 trillion insurance freeze was the first domino. February 27th is when the chain reaction becomes unstoppable. And somewhere between here and there, the gateway to physical metal closes permanently for everyone who waited too long to understand the difference between paper promises and tangible assets. The choice has always been yours. The timeline just got a lot shorter.